everyone, and welcome to the quarterly update from Connecticut Wealth Management's Investment Committee. I'm Megan Trask, joined by my colleague, John Shanley. John and I are probably perpetually optimistic about markets, but with the changing weather here in New England, it's hard not to be optimistic about just about everything right now.
It's beautiful out there, that's for sure.
It really is. So the plan today is to give you an update, really high level on the market environment and weave in sort of how our portfolios are responding. So as always, it's a full agenda and we'll try to condense it down to a couple of minute update for you. With that, John, do you want to dive right in and just what's been happening year to date and what and how does that also impacting long-term returns?
Absolutely. Yeah, so we're going to share a couple of slides today, but the first one you're going to see, there's going to be a lot of data, but we're going to try to really hone in on performance on a year-to-date basis, but also look over the last 3 years to get some of that perspective, given all the news that might be out there. So the chart that you're about to see is going to show the return of three key indexes that we look at on the investment committee. The first one is the S&P 500. Many of you have heard of that. That is the performance of the largest 500 stocks in the United States. Right underneath that, you're going to see something called the MSCI ACWI. What a name. But that is a global index for all of the stocks in the world, US, international, and all the rest.
And I'd just like to interject to say that's really the benchmark we use here to judge the performance of our stocks because our clients, we believe, should have diversified portfolios, owning stocks both in the US and international. So that's really our go-to stock benchmark.
You've got it. And just as to understand what ACWI means, it means All Country World Index. That's what that index is short for. And then the final one you'll see there is the Bloomberg Barclays Aggregate, which is a bond index. So Megan alludes to it, but we use that ACWI index and then the Bloomberg Barclays Ag to really understand what the marketplace is performing and then also to understand where our opportunity set may lie. You'll see there's going to be a red box there where we're going to hone in on the performance of those three indexes over the year to date, so from January 1st until May 8th. And then we'll also look at a 3-year performance. The story this year has been strong returns throughout. The equity markets, whether it's US or international, are up about 8% and above. And then even in the bond market, the bond market now is up slightly over or just at 3% as of today's market data. So we've seen really strong returns after what was obviously an eventful 2022. Now, we would argue, right, that 5 months really doesn't give us anything from an investment perspective or there's not much to learn. So what we instead want to do is look at a longer time period. And you can look over the last 3 years. In that time period, incredibly enough, the US stock market, the S&P 500 is up 14% annualized. Even global stocks, all that they've lived through are up over almost 12%, 11.92%. And then the outlier in this whole benchmark is the Bloomberg Barclays Ag. So it's been a challenging ride for the bond market, as we discussed quite a bit last year. And we're still seeing returns recover from what they've been, kind of the ride that they've experienced these last couple of years. Before I move back on to kind of current market events, I think the key message when you look at this data set, we look back at the last 3 years and there's so much that has happened, right? It's kind of remarkable to think about. In May of 2020, we were just going through COVID, right? That was we were still working at home. We were filming these videos in our basement, so to speak.
Saw a huge market drawdown.
That's right.
Yeah.
We went through so much from political contentions, the war in Ukraine, inflation, all of the data points that we've talked about and worried about, so to speak, over these last couple of years. But still, we sit here with remarkably strong equity returns. And it's it ties to that idea of patience and perseverance. Being patient has rewarded us as investors.
Exactly. And I know in client meetings I've had, I think our clients and investors are surprised to hear that those are the 3-year return numbers because of everything you just referenced. And I think it is fairly reflective of kind of how market cycles work. 2020 ended up being a wonderful year for the stock market. 2021 was a good year for the stock market. 2022 was a dismal year for the stock market. When you average those out, you get these normalized return numbers. And so it's so important to keep that longer term perspective.
Markets have a way, I feel like, of always giving us a dose of humility. Because if I went back 3 years and we laid out to the investment committee, this is what's going to happen in the world, I don't think any of us could have predicted these types of returns. So while you always want to have conviction and try to understand what markets are going to do and where there's opportunities, you also have to have a lot of humility that things will move and gyrate in ways that you can't really imagine in that moment.
Yeah, well said. So I think it's probably hard to talk about current market environments without talking about the potential for an economic recession that continues to dominate the headlines. I've got another slide here that you'll see. The slide title is called Recession Indicators. So we're looking at a dashboard from our friends at ClearBridge Investments. It doesn't matter which research shop or analyst you follow. Most are indicating that they expect a recession in the U.S. economy to occur, later this year or early in 2024. You'll see on this slide, we sort of cherry picked a handful of indicators, both on the financial side and on the consumer side, that historically have given us some clue of whether, again, we may be entering a recession. And pretty much any data point you look at, or at least the large majority of those data points, are indicating recession. Whether you look at the U.S. Treasury yield curve or consumer spending or housing starts, starting to see some weakening data. Of course, one of the big standouts is still the labor market, which remains really, really strong. In summary, as we've talked about, it's hard to predict these things. And I think the more important point is, even if we knew with certainty that a recession was coming, we cannot predict how the stock market will react to that. And history has shown us that the stock market and economic recessions do not move in parallel or lockstep. In fact, recessions can oftentimes be a wonderful investment opportunity.
What's remarkable, I feel like the last 18 months, this recession word has been everywhere. So it feels like the recession's right around the corner, but the corner keeps getting pushed back. Yeah. So it's impossible to try to not only time these things, but also to predict what the market movements are going to be from that, right? Just as you allude to. It's the complicated nature of economics and investing and how they relate, and sometimes how they don't relate, especially in shorter time intervals.
Yeah.
The next chart that we're going to see now is going to also kind of tie to what you talk about with the recession and a lot of the fears that are out there. Last year was a unique year where inflation was at highs we hadn't seen in such a long period of time. And consumer sentiment, right? How we feel about the economy as consumers and people in the society was very negative. The chart that you're going to see is going to show where consumer confidence was. And it's still at pretty low peaks. Yeah. And rightfully so, right? There's a lot of news out there, and majority of the time the news will be negative. It's just going to slant negative. But what's remarkable, and what this chart really illustrates, is that there is a dichotomy between how we feel as investors and what the right thing to do as investors are. So sometimes it's in times where the consumer confidence is lowest, where prospective returns are the highest. Yeah. And it's also vice versa. When people feel the best, it's usually a time where market returns may actually be lower. So this is sometimes, I've heard Charlie Munger, who's Warren Buffett's kind of right-hand man, describe investing as simple but not easy. Yeah. Which is the idea that the core ingredients of being a successful investor aren't necessarily rocket science, but it's not necessarily easy to live through, because it goes so much against our human nature that when times look bad, that's usually when we should be the strongest in our perseverance for the economy. When times are exuberant, maybe you want to kind of rein some things in. So it's a dichotomy between exuberance and what markets might tell us.
Yes, and so this chart is from J.P. Morgan. For those of you who were on our Fidelity call, this was a prominent theme in that call, and Fidelity studies this data really closely as well. So this chart is showing us where you see that kind of blue dotted line, where you see the line chart go below the blue dotted line, indicates periods of time where folks, everyday investors, were really nervous about markets and the economy. And so if you fast forward to 2022 and 2023, you see a really deep decline in this line, indicating, again, really poor sentiment. But again, if you summarized all the returns after that poor sentiment, the average returns for the next 12 months, are as high as, 25%?
25%, that's right.
25%. So again, going back to the sort of segue to this slide, the toughest of times can really present the greatest investment opportunities.
Exactly right. Exactly.
The last chart we'll look at today, I think we've looked at this in the past, and this is an updated version. And really what it describes is that volatility in the stock market is very normal. We often say around here, it's the price that we pay to access growth over long periods of time. That growth doesn't come for free. The chart that we're looking at here all of the gray bar charts describe the ending year return for the S&P 500. All of the red dots below indicate the return, the biggest drawdown at some point during that year. So if we highlight, for instance, 2021, the stock market returned 27%, but at some point during that year, it was down 5%. And you can see every single year, even if the market finishes higher, there's volatility along the way. There's significant drawdowns. I think that's increasingly important to talk about as we're encountering a barrage of negative headlines. Our Congress will be negotiating our debt limits in the coming weeks here, and we're bound to see some concerning headlines that may even provoke a pretty significant market drawdown. Again, what causes these drawdowns is different every single year, but there's commonality in that they occur, and the market still is able to persist and recover and often finish positive that same year. Again, if we look from 1980 to 2022, the stock market's positive 32 out of 43 of those years. Those are, continue to be really good odds, and this data continues to remind us that while it doesn't feel normal when we're reading these headlines, and there's a lot to be concerned about, the way the market reacts in the short term and the volatile nature continues to be normal.
One of the great points of this chart is you can look at all those red lines together, those red dots, and you can average it. And over this entire time period, the average drawdown within the year is almost 15%. I know when we're living through those experiences, they don't feel good, right? 15% drawdown is never a fun experience to live through, but it really is almost par for the course. There's going to be some years that don't go down as much and some years that do, but if you can kind of persevere through those downturns, it tends to lead to really quite strong returns. And we were just talking, over this entire time period, the markets are up about 11.5% per year. That's a remarkable return that you can get over a 40-year time period, but it's not free. You unfortunately have to live with those drawdowns in order to achieve those strong long-term returns.
Well said. So hopefully a couple of these kind of themes and data points give you a sense of the current market environment and some of the things our investment committee is thinking about. As always, if you have any specific questions as it pertains to your portfolio, please reach out to your advisory team. Again, we remind all of our clients to stay focused on the long term, stay focused on your plan. And we're here for you along the way.